Common mistakes in SaaS valuation include failing to correctly capture growth, assuming that pre-revenue companies means they have no value, incorporating the value of sweat equity, failing to properly capture the impact of capital structure, and what KPIs actually matter. A mistake failing to correctly capture growth would look like using a long-term growth rate that either is unsustainable because it's too high or is undervaluing the company because it's too low. When you assume that pre-revenue means no value, you're ignoring the venture capital markets, which are routinely valuing SaaS companies at multi-million dollar valuations every day, often years before they achieve sustainable revenue. Frequently, sweat equity is believed to have some value, but in reality, investors don't care about sweat equity. Sweat equity is simply whatever was invested to make the company valuable at all and to make it attractive to investors. But that's something that is rarely paid for by a third-party buyer. I frequently see valuations failing to capture the impact of capital structure because we're often taught that securities such as preferred stock are basically debt, but now we understand them to be much more complex and sophisticated than that. In fact, they're hybrid securities, and therefore more sophisticated techniques must be used in order to value them properly. You can tell when the wrong KPIs are being used in the valuation because they're not relevant to the company at hand. Many practitioners who are used to valuing more conventional companies will use conventional KPIs, but those KPIs don't apply because the nature of the SaaS business model is so fundamentally different.